Laurie, welcome to MSPland. How are you doing today?
Yeah, good. Thanks, Nick. Thanks for having me.
No worries. Great for you to be here. I'm pretty excited about this episode, speaking to another Access4 native and going into a topic I'm probably not as well versed in as I probably should be. So I know there's going to be heaps of learnings for myself, but also for the other business owners and directors of MSPs out there. I think we'll get a lot of benefit from this. So just to begin with, though, can you please give me a bit of an introduction to yourself out there for those who don't know you, as well as what your sort of Access4 story is?
Yeah, absolutely. So obviously, my name's Laurie. I'm the finance director at Access4. Back in the day, I sort of was an auditor. That's where I started my trade. I initially found out pretty quickly that wasn't for me. It was a great sort of set of fundamentals that I learned from a business perspective and from a finance perspective.
Yep.
But I definitely found my passion was in being within a business and helping that sort of grow and thrive and looking at it from a financial aspect and trying to help different departments as well think about their contribution and their financial sort of implications of that as well. So started there and then I sort of commenced working with Tim Sargent-Stan, some of the founders of this business at a previous role. When they sort of identified the opportunity for MSPs and CSPs to take the sort of lion's share of the voice wallet from sort of the bigger players, it made sense for me to jump on board and really be part of that journey.
Yeah, cool.
I started out. It took as a numbers man. It took me a while to actually justify my role. We'll talk about financials and cash flow and predicting out in that regard. But I sort of worked behind the scenes for a couple of years, and then sort of in October 2018, sort of I came full time.
Yeah, cool.
It's been a bit of a diverse experience since then, wearing many different hats, but it's been a fantastic journey, and I'm looking forward to sort of the next chapter.
Yeah. And I know you're involved in so many aspects of this business, not just squarely the financial side. I always sort of remember when Matthew Jamison, our head of channel, came on board. He was like, "Oh, it's the first time I've worked with a finance director who knows what SIP is. It's so refreshing." So that just always comes to my mind. But look, let's just jump into it. We've got a bunch of different topics to go into. And I just want to start with a bit of a more general question around, if you are a business owner, if you're running an MSP, when it comes to the financials of a business, what do they really need to be thinking of and most aware of?
Yeah, look, it's a good question, and each business is going to have sort of its own objectives. I think there's probably a couple of key things to know and understand to be able to sort of know what levers you've got to pull in various scenarios. So you've obviously got the sort of key financial statements being the profit and loss, the performance of a business. You've got the balance sheet, which is, where you're at a certain point in time.
Yep.
And then sort of a statement of cash flow, which really is the bones of a lot of what a business is and what you need to focus on. But then sort of stepping up a level to understand what you want from a business perspective, you need to sort of consider a couple of things. And that's one, who are your key stakeholders? So for example, your shareholders.
Yep.
What do they want? And that sort of helps drive a lot of the strategy that you're going to put in place. And depending on what they want, and that they have a couple of different options about sort of how they think about that particular business, and either they're very focused on a dividend, they're focused on sort of enterprise growth and the value of that business, or maybe a sale at the end of the day, right?
Yep.
And I think based on where your stakeholders are looking is really drives what levers that you'll look at within your business.
Sure. Yeah, so if you're privately owned, if you're owned by private equity, if you have a few different private investors, it's all going to change what your strategy will essentially be from a financial perspective, because you have different levers which you can pull.
Absolutely. So take your example of a private equity, right?
Yep.
They're generally motivated by sort of increasing the value of the business for a sale at a certain point in time.
Yep.
And depending on how that business is valued, it might be on a sort of ARR or revenue multiple or an EBITDA multiple. You then look at the business a certain way in order to, achieve those objectives.
Yep.
So for example, if you're valued on a revenue basis, you might then focus a lot on the different types of strategies. So it's not really a lever as such to pull, because when I think about levers, you're sort of pulling back on something.
Yep.
But really, you're looking for the types of strategies and growth strategies that's going to play out over the time period that sort of shareholder is interested in.
Yep.
And so what you're doing in that scenario is placing a series of strategic bets. Ideally, those sort of strategic things have a certain amount of growth attached to them, and you're ranking them in order of where we think that sort of market share is going to come from. And flip side, if it's an EBITDA company, or you're sort of more after that sort of sustainable profitable growth, that you see it on the bottom line as well as the top line. But it might it's a similar type of strategy, but you're just considering more than just the top line growth. And then finally, you got your dividends as well, which is a very similar comment. You want sustainable growth. You don't want growth at all costs in that scenario. And therefore you're still ensuring your business is resourced adequately to get that profitability. But it's not as sort of dear or as aggressive as, say, a top line growth strategy.
Yeah, fair enough.
And then you've got your crisis mode,
okay,
which is you're not so focused on growth. Maybe you've got sort of really tight cash flow constraints and things like that. And you're forecasting out over the next couple of months that you're going to have issues. And then you sort of look at other things within your business. What's a discretionary spend? And I'm sorry to say, Nick, that
it's not marketing, right?
Marketing is looked at pretty quickly in that scenario. But you'll look at the discretionary spends. You'll look at ad hoc projects, that sort of thing that you've strategically put up, but maybe there's an opportunity to delay that to ensure that you're sort of making the cash that you need to do to sustain your business. And then there's other things like potentially delaying capex and other things.
Okay.
So a lot of different things, but I suppose the key point to get across is it really depends on, one, your stakeholders, and two, your position.
Yeah, cool. Well, that's a good segue into then talking a bit more about cash, as you mentioned, specifically managing cash flow, because for any business out there, managing your cash flow is something that's probably keeping the business owners up at night, right? You need to be able to pay salaries, you need to be able to pay vendors, everything else. So if from your perspective and in your experience working with MSPs and in our partner business, in our partner network, like what should businesses be thinking about when it comes to managing cash flow? What are your sort of top tips?
Yes. So cash flow fundamentally is, the most important thing that I do within the organisation. Any finance or any business owner will be thinking about it very regularly. I think, it's important to recognise at what stage a business is in when you think about cash flow. Like I'm thinking about when Access4 started, we're a high investment company, and we quickly found that in order to make this a successful platform and a successful company for our partners, we'd need to invest heavily at the front, which typically means you need to source funding, and the ability to then see where we need to invest, where our sort of revenue profile is growing, and understand, a bit of a balance of getting money in but not too much, that you're giving away too much of the company in that scenario. That was really important at the outset. So understanding where you are and where you're heading over the short to medium term is really important in terms of managing cash flow, and the ability to tell a story about your company. Because at the end of the day, if you do need external investment, you need to be able to tell a really good story to investors, and you need numbers to align with that story and really back up what you're saying. And so, if you're at early stage, that's a really important part of managing your cash flow. If you don't have that foundation customer that sort of helps sort of generate that business, generate the cash flows for that business.
Yep.
And then sort of when you get to later stage, it's all about, predicting where you're going to be at a certain point in time, right? You've got a bit more history in your customers and how your customers are growing in your platform. I'm thinking back to sort of how we do our strategy now. It's really a 36-month plan with a lot of detail within the next 12 months to understand where we're heading, where we can invest. We're quite lucky in the fact that we're a very high recurring revenue business. And what recurring revenue does is it provides a consistent cash flow, but it's also predictable. So we can go back over, 12, 24, 36 months and understand, how often we're sort of bringing on new customers, the retention of those customers, and really provide a bit more of an accurate forecast as to where we're heading, right? Yep. And that provides us the ability to, identify where we might have that additional cash flow to place a couple more of those strategic bets. Yep. One of those, as a recent example, is UC Express. Yep. A product that's taken sort of 12 months to bring to market. And, we made sure we had adequate resourcing in order to sustain that product over the development time, and then sort of launch that earlier this financial year. And so different stages, things like recurring revenue definitely help me have less sleepless nights when it comes to cash flow. But also, getting in some really solid investors that are in it for the long term, who buy into the journey and buy into the numbers and where we're heading, really important. But you can never quite keep your eye off cash flow. Yeah. It's definitely something that needs to be close to the top of the list at all times.
Cool. But as you say, recurring revenue is it provides so much stability, right? Because then you have that, you can predict where things are going to be a lot more accurately. And that's, we always talk a lot with our partners around, we need to get them hooked onto that recurring revenue model, because once they sort of get hooked into it, they're never going to let it go. And, starting to move away from those project or big CapEx selling instead, because recurring revenue is just so sustainable for a business, because, it's not guaranteed, but you can see it recurring and ticking over every single month. And then, as long as you're looking after your customers, you really build a great base for yourself. And then that helps you in so many other ways, especially from the financial side of things that you're talking about, right? If you're wanting to get investment or funding or anything else.
Yeah, absolutely. Recurring revenue really de-risks your organisation, and sort of provides you stability in times where, in the past you might not have been able to trade through in certain scenarios, right? Because you've got that solid base. And yes, you need to absolutely make sure that your customer and partner service is top notch, because once you focus on recurring revenue, you also need to sort of put a active focus on retention as well. Yep, that's it. Because recurring revenue is not very useful if your customers are leaving.
Yeah, if the churn rate's high, you're building a good base, but people are dropping off, and you're not recurring anymore, pretty much. Yeah, absolutely. Cool. So I want to take a bit of a different turn now into key performance indicators. KPIs are something everybody understands, but it's and everyone has a KPI, which might make them a bit scared, but also it's something that companies use to reward their staff and their team, but also keep them in the same direction. So how important are KPIs? And I mean, do you feel there's enough of a focus when it comes to business planning and whatnot from your experience in working with MSPs?
Yeah, KPIs and having that sort of North Star for an organisation is really key. I think, having a KPI that can be filtered throughout the organisation is really important. Even if it's not like an individual department that, owns a revenue number, for example, but they should have their own, in my opinion, KPI that really talks to that North Star that that the organisation puts up as the key thing to do in the next 3 to 5 years. It helps alignment within that organisation. It also helps, having genuine conversations between departments to be able to, we know we align on these KPIs because they're all heading in that right direction. So for us, transparently, from a sales perspective, it's MRR.
Yep.
That's grown over time. We had some learnings at the beginning of Access4 where we focused just on subscriptions and found out that, that didn't really come to the heart of the matter.
Sure.
When it comes to just pure, motivation of the sales force and everything like that. But when we talk to our individual departments, they've got their own sort of metrics that sort of tie into that. For example, our porting team, we pride ourselves on being one of the better porting organisations and really trying to get the best result and get it on quickly, right? So Cat A and Cat C port times is really important to sort of minimise that and devise different strategies to reduce that, as well as, TAC and our support team. And all these, and for TAC it would be, satisfaction and time within SLA. First resolution, right? And those all tie back to our North Star of the strategy of Access4. And so when we've got TAC at go-to-market in a room, we're all working to that same objective. I think that's really important. But you also need sort of the transparency around the organisation for everyone to know their own KPIs as well.
That's it.
So it deserves time and attention to get that right, but it does take time to make sure that you believe those metrics are all sort of relating back to that key North Star of the organisation.
Yeah, cool. And look, I think everyone's probably seen it when KPIs go badly. One department or a certain team has KPIs that don't ladder up into that North Star of the company, and they might be absolutely knocking their KPIs out of the park, but the overall business performance might not be. So you get to the end of the financial year and they're having conversations about remuneration and everything else, and they're just like, well, this is going to be guaranteed. But then from a business perspective, they're looking at, well, we're not actually hitting our revenue targets or whatever that overall sort of North Star is. So like from my perspective, it's so important to make sure that whatever KPIs are set within a different departments, that they do ladder back up to that North Star. Because if they don't, you're not going to be aligned, and then it's going to cause all sorts of problem down the line, especially when it comes to things like remuneration.
Yep. Absolutely. No, it's really important to get it right. It's important to continuously review as well, right? Because the KPIs you set over the last 12 months might not be the KPIs that help you drive the business forward within the next 12 months. Yeah,
good stuff. Cool. Now I just want to get into a bit of a chat around funding a business. I think everyone out there would love to be able to have super high organic growth rates, but it's not always the case, and it's not always the right move as well, especially if you have a certain opportunity or a market you want to get into, where there's opportunity, but maybe your organic growth rate doesn't sustain the amount of investment you might need to make. So if you're a business owner and you're looking at funding, what are your options, and like what do you really need to think about when it comes to funding?
Yep. Good question. So I've mentioned one of them before, which is sort of funding your own business using your own cash flow. Not every business, as you say, is in that position to be able to do that. And it's incredibly important at the moment within this environment to understand at what level you're at. Because I think over the last 12 months, we've definitely seen shifts in the market about, the best way to structure your business to be funded in those sorts of things. So in the profit example, you're forecasting out, your cash flows over the next couple of years and you're reinvesting that, right? To be able to find those opportunities and then take advantage of them without having to raise money elsewhere. So that's the simple one if you can do it. But again, not every business is in that scenario. Another way is taking on debt, simply sort of getting a loan. Now, not as simple as I make it out to be. You've got a couple of ways and people to organisations to talk to. One, you've got your standard bank that will have a really good or really solid level of security that they take from business owners, and that might be a director's guarantee. It might be guarantees against personal properties and things like that. They'll provide you potentially the best interest rate, but they will be absolutely sure that they'll get their sort of funds back at the same time. So that's one level. You can also go sort of, debt that doesn't have that sort of financial guarantee. There are some new ones coming out that, finance based on your recurring revenue base, right? And so you're not, in that case, you're not giving away as much security, but what you're doing is you're paying, an increased interest rate because that source of financing is higher risk for that bank, and therefore they require a higher rate of return. And so that's a couple of examples on the debt side. You've also got the option of raising equity, so selling shares to fund your business. It's got a lot of the similar characteristics of debt. You'll go through a very similar process, probably more so on the
due diligence side and everything.
But it's and you're essentially diluting your company in order to raise money that way. And what's important behind that scenario is having the story behind your business, understanding and being able to show where you're heading, and having your numbers sort of match back and really align to that, so that an investor can see where their return on investment will be. So, and then you've got sort of some hybrid scenarios where you can get something, say, like a convertible note, which is, potentially at the investor's option. You raise a loan that can convert into equity at their option, depending on certain scenarios being set. That might provide the investor, some more comfort in being willing to provide funds as well. So there's a wide variety of ways that you can fund your business, and it really depends on your business circumstance and sort of where you're heading, about where you might go. But I'd say over the last 12 months, it's definitely got harder to do all of those things, right? Because interest rates have increased.
We're all feeling that squeeze.
And so banks are obviously looking at increased interest and principal repayments, and it's affected valuations as well. So you might now be giving away a bit more of your company than you would have 24 months ago in order to secure that funding.
Yeah, cool. And how important is recurring revenue in all of that?
Critical, in my opinion. I think, so we talked about recurring revenue before. What recurring revenue is it's consistent and predictable. So on the forecasting through profits and being able to see where you'll be in 6, 12, 18 months, really critical in making those sort of strategic decisions, whether you're going to hire, whether you're going to pull off another project or another product. It really helps in sort of laddering up where you'll be over a certain period of time. So that helps internally. It helps with the management of the strategy, the communication internally, and the resource planning. When it comes to debt, banks are mostly interested in getting back principal and interest, right? So that would be their focus. And what recurring revenue does is it shows them an ability to pay over a period of time. So if you can trend sort of where you're heading as well, they'll be more likely to see that their principal and interest can be paid with historical sort of trends really informing that. And that de-risks them to a certain extent, right? So it might be able to, either get them over the line on whether they're willing to lend to you, or they might be able to give you sort of slightly better terms associated with that debt. But a higher recurring revenue base will make that conversation and that due diligence process a little bit easier. Not saying that it's going to guarantee it, but it definitely puts another string in the bow in order to sort of get that one over the line. And then on equity and sort of raising money via selling shares, it's a very similar sort of concept, because at the end of the day, the investor is looking for return on their investment, right? And if we can de-risk that return on investment, they might be willing to pay more for the company, and you might be giving away less of your company to raise those funds, right? And again, similar thing, the more that you can sort of ladder up your existing customers and show them where you're heading with, retention rates and obviously margin as well, that's going to put you in a better position to be able to have that discussion with those investors.
Good stuff. All right. Well, look, I think we've went through everything today. Really insightful stuff there. I know I've learned a bunch that I probably should have known before. So, probably I want to ask you for more budget now, especially after that comment about the discretionary budget. So, but yeah, look, thanks a lot for coming on. For anyone listening who might want to get in touch with you, what's the best way for them to reach out?
I can reach out my email, laurie.coll@access4.com.au, or reach out on LinkedIn as well.
Yeah, good stuff. All right. Well, thanks a lot. See you around the office, and hope to have you back on here again soon.
Perfect. Thanks, Nick.
Thank you.